18%. That's how much registered silver inventory disappeared from COMEX vaults in 72 hours. Not an eligible inventory that can sit indefinitely. Registered inventory, the silver that's actually available for immediate delivery. Between December 28th and January 2nd, 31 million ounces moved out of the registered category. This kind of movement doesn't happen during holiday trading. Markets are thin. Most institutional desks are running skeleton crews. Yet someone was moving silver, a lot of it. The timing is what makes this unusual. The withdrawals began December 28th, 4 days before any public discussion of Caribbean military operations, 5 days before official announcements. The pattern suggests knowledge that wasn't public. When you look at the withdrawal velocity, it wasn't gradual. It wasn't spread across multiple participants making independent decisions. The outflows show coordination, large blocks moving in synchronized windows, the kind of pattern you see when multiple parties are working from the same information the rest of the market didn't have yet. This isn't about whether military tensions will escalate. That's not what the data shows. The data shows that someone knew something was coming, and they acted on it before anyone else could. COMEX registered silver inventory is one of those numbers most people never think about, for good reason. Most of the time, it doesn't matter. Silver sits in vaults. Traders trade paper contracts. Physical delivery is rare. Maybe 3 to 5% of contracts result in actual metal changing hands. The system works on confidence. The confidence that if you want physical silver, it's there. Registered inventory is the buffer that maintains that confidence. It's the silver that owners have specifically designated as available for sale at current market prices. When you hold a COMEX futures contract and decide to take delivery, registered inventory is where your silver comes from. Eligible inventory, by contrast, is just stored there. It meets COMEX specifications, but isn't for sale. The owner might sell it someday, or might not. You can't force the sale of eligible silver. Only registered silver is actually available to satisfy delivery demands. Normally, registered inventory fluctuates within predictable ranges, some days up, some days down. Market makers move metal in and out based on arbitrage opportunities. Industrial users take delivery when they need physical supply. Miners and refiners add inventory when they need to sell. It's a functioning market, boring even. The ratio between registered and eligible stays relatively stable. When registered inventory gets low, eligible holders convert some to registered to capture premium prices. When registered gets too high, some converts back to eligible. The system self-regulates, which is why an 18% drawdown in 72 hours stands out. That's not normal fluctuation. That's not regular market making. That's systematic withdrawal. The kind that happens when someone believes registered inventory is about to become very important. When someone believes the normal 5% delivery rate might not hold. When someone believes they need physical silver in their possession, not a paper promise that silver exists somewhere in a vault. The withdrawal started December 28th at 1400 hours Eastern. Not at market open, not at the London fix, right in the middle of the trading day. The first block was 11.2 million ounces. That's already unusual. Most large withdrawals happen at standard settlement times. This one didn't. 4 hours later, another block, 7.8 million ounces. Same authorized participant codes, same vault locations. By market close, 19 million ounces had shifted from registered to withdrawn status. Not eligible, withdrawn, removed from the COMEX system entirely. December 29th was a Saturday. Markets closed, but COMEX vault reports still update, another 4.3 million ounces, withdrawn on a weekend. That requires special authorization, additional fees, overtime costs for vault staff and security. Someone paid extra to move metal on a Saturday. December 30th, Sunday, the pattern continued, 3.9 million ounces. By Monday morning, before markets opened for the shortened New Year's Eve session, 31 million ounces had left the registered category. The normal weekly movement for registered silver is between 2 and 5 million ounces, both directions combined. This was 6 times the normal weekly flow in one direction during the slowest trading period of the year. The withdrawal patterns showed another anomaly. Typically, large inventory movements come from multiple vaults, risk distribution. This drawdown came from just 3 locations: the Delaware Depository, C&T Depository, and JP Morgan's facility. 3 vaults, 72 hours, 31 million ounces. Someone was consolidating physical silver from specific locations. The kind of behavior you see when counterparty risk suddenly matters, when you need your metal in specific vaults, or out of the system entirely. History provides context for rapid precious metals withdrawals. Not perfect analogies, but patterns worth examining. March 2020. In the 48 hours before travel restrictions were announced, COMEX Gold registered inventory dropped 23%. The withdrawals started March 11th. The travel bans came March 13th. The parties withdrawing gold moved 2 days before public announcements. October 1979. During the Hunt Brothers silver accumulation, registered silver inventory fell by 35% in 5 trading days. But that was different. The Hunts were publicly acquiring silver, taking delivery on futures contracts, broadcasting their intentions. This December withdrawal was silent. No public futures positioning, no announced delivery intentions, just metal leaving vaults. August 1971. In the week before Nixon closed the gold window, Fort Knox saw its largest outflows in peacetime history. Foreign central banks were converting dollars to gold at an accelerating pace. They knew the convertibility promise was about to break. The pattern was similar, quiet, systematic, concentrated in time. The Libya intervention of 2011 offers another data point. In the 96 hours before the no-fly zone announcement, London Bullion Market Association silver inventory dropped by 12%. The withdrawals started March 15th. The UN resolution passed March 17th. Again, someone was moving before public information. Each historical example shares characteristics. The withdrawals begin before official announcements. They are concentrated in compressed timeframes. They involve specific vaults, not system-wide movements. And they're conducted by parties with apparent advanced knowledge. The December 28th silver movement fits this pattern. Compressed timeframe, specific vaults, movement before public information. But with one key difference. The historical examples all preceded events that were partially telegraphed. Central bank meetings, UN debates, public military buildups. The Caribbean situation had none of these advanced signals, which raises the question of how anyone knew to start withdrawing silver 4 days before the first public indication of military operations. While silver was leaving COMEX vaults, other markets were showing their own quiet anomalies. The 10-year Treasury overnight repo market. Between December 27th and January 2nd, overnight repo rates moved in a pattern that doesn't match year-end dynamics. Typically, year-end sees repo rates spike, balance sheet constraints, banks pulling back. This year-end was different. Rates stayed compressed, unusually compressed. Someone was providing liquidity, a lot of it. The kind of liquidity provision you see when large institutions need to move assets quickly without disturbing prices. The Turkish lira forward market showed similar irregularities. 3-month forward points, which normally trade in a tight range, widened by 40% in the same 72-hour window. But spot prices barely moved. That's not currency speculation. That's positioning for future delivery. Someone was locking in lira for March, large amounts, without touching spot markets. The connection between these markets isn't obvious. Silver, Treasury repo, Turkish lira forwards, they don't typically correlate. Different asset classes, different participants, different risk factors. But institutional capital flows create patterns. When large entities need to reposition quickly, they can't use traditional channels. They need liquidity, they need forward positioning, they need physical assets outside the banking system. All three markets showed this pattern. Starting December 27th, the same day silver withdrawals began. Here's what makes this convergence unusual. The repo liquidity wasn't coming from typical providers. The transaction codes suggest sovereign wealth funds, maybe central banks, entities that don't normally provide year-end repo liquidity. They were facilitating something. The lira forwards weren't being bought by carry traders or Turkish corporates. The flow patterns suggest commodity traders, possibly energy traders, locking in currency for future physical purchases. Three markets, three different types of unusual flow, all starting within hours of each other, all involving entities that don't typically participate in these specific trades, all creating conditions for large asset movements without price discovery. That's not coincidence, that's coordination. These patterns don't prove military planners shared classified information with commodity traders. They don't prove insider trading. They don't prove market manipulation. The data shows correlation, not causation. There could be explanations that don't involve advanced knowledge. Year-end portfolio rebalancing sometimes creates unusual flows. Maybe a large fund was restructuring positions. Maybe new regulations required physical backing for certain derivatives. Maybe industrial users were securing supply for anticipated first quarter demand. The repo market liquidity could be unrelated. Some sovereign funds do provide year-end liquidity. Not commonly, but it happens. The compressed rates might reflect excess reserves seeking yield. Any yield, even negative real yields. The lira forwards could be standard corporate hedging. Turkish companies do lock in currency for future imports. Energy traders do use forwards. The timing might be fiscal year planning, not geopolitical positioning. Even the vault concentration might have innocent explanations. Maybe those three depositories offered better withdrawal terms. Maybe they had superior logistics. Maybe other vaults were undergoing year-end audits. It's important to note what we can't see. We don't know the identity of the withdrawing parties. COMEX reports quantities, not names. We don't know if the same entities were active in repo and currency markets. We don't know their motivations. The withdrawal data is factual. 31 million ounces left registered inventory. The repo compression is factual. The lira forward widening is factual. But the connection between these facts and Caribbean military operations remains inferential, not proven. The patterns are unusual enough to notice, not clear enough to conclude. This distinction matters. Unusual patterns deserve attention. They don't deserve certainty. Not yet. 3 indicators deserve monitoring in the coming weeks. Not for trading, not for immediate action, for pattern recognition. First, the COMEX delivery cycle. January is not a major delivery month for silver. March is. If the entities that withdrew 31 million ounces were positioning for delivery pressure, March will reveal it. Watch the open interest in March contracts. Not the price, the contract count. Specifically, watch how many contracts remain open through first notice day. Normal spec traders exit before delivery. Entities wanting physical metal don't. If March open interest stays unusually high into the delivery period, it suggests the December withdrawals were preparing for something. The second indicator is more subtle. Refinery premiums in Singapore and Dubai. Physical silver trades at a premium to futures prices. This premium fluctuates based on immediate availability. Normal premiums run between 50 cents and $1 per ounce. During the March 2020 disruptions, premiums hit $4. If refinery premiums start climbing above $2, it indicates tightness in the physical market. The kind of tightness that follows when large quantities leave the system suddenly. Monitor weekly, not daily. Daily fluctuations are noise. The third signal involves seemingly unrelated markets. Turkish energy imports, specifically the payment mechanics. Turkey imports significant energy supplies. Historically, these payments flow through standard banking channels, dollar and euro settlements. If payment patterns shift toward physical commodity settlements, particularly using precious metals, it connects to those unusual lira forward positions. This data appears in Turkish central bank monthly reports. Usually buried in supplementary tables, the reports lag by 6 weeks, but when they appear, check Section 4, Subsection 3, International Settlements by Method. These 3 indicators form a pattern recognition system. COMEX delivery pressure would confirm positioning for physical tightness. Rising refinery premiums would confirm actual tightness developing. Shifted payment mechanisms would confirm the currency forwards were connected to commodity flows. No single indicator proves anything. Together, they might reveal whether December's withdrawals were isolated events or part of something larger, something still developing. The data will emerge slowly, weeks, not days. That's how structural shifts appear, quietly, incrementally, until suddenly they're obvious to everyone. By then, the positioning is complete. The parties who withdrew silver in December, who provided repo liquidity, who bought lira forwards, they're already positioned. Everyone else is still trying to understand what happened. Nothing is breaking in silver markets today. The spot price remains stable. Futures trade normally. Industrial users are getting their metal. The financial system functions. But 31 million ounces didn't leave COMEX vaults because everything is normal. That silver is now in private vaults, or in transit to private vaults, outside the price discovery system, outside the fractional reserve metal banking system. Someone wanted physical silver, not exposure to silver, not claims on silver, the actual metal. They wanted it badly enough to pay weekend withdrawal fees, to coordinate across 3 specific vaults, to move during the thinnest trading period of the year. And they started moving December 28th, before public information suggested any reason for urgency. The repo liquidity provision and lira forwards might be connected, might not be, but they started the same day, showed the same urgency, the same willingness to pay for immediate positioning. Markets reveal information through price, but sometimes they reveal more through behavior, through the patterns of who does what, when they do it, and how urgently they act. The December silver withdrawals were behavioral information. Someone with resources and sophistication decided physical silver outside the system was worth more than silver within it. They acted on that decision with coordination and urgency, 4 days before anyone else knew why. These patterns don't predict outcomes. They reveal positioning. Someone is positioned for a world where physical silver matters more than paper claims, where repo liquidity matters more than yield, where lira forwards matter more than spot prices. Maybe they're wrong. Maybe year-end 2024 was just aggressive portfolio rebalancing. Maybe the Caribbean military operations are unconnected. Maybe registered silver inventory rebuilds next week. But 31 million ounces of silver doesn't move by accident. That metal is somewhere now, in someone's control, outside the system. They knew something on December 28th, something that made them act. The rest of us are still catching up to what that something might be. Nothing is broken, but something has shifted quietly.